Hey guys, in this video we'll be talking about how to invest in stock for beginners. It's your boy Young Diamond. Welcome you to this video once more. Now we'll be talking about how to invest in stocks for beginners. How to invest in stock for beginners. Now what is a stock? A stock can be defined as an equity representing ownership of a company. Now when you buy a stock, you are buying a portion of that company. The stock is an equity. Now a share is a unit of a stock. So in most countries, they are used together. When you talk about shares, it also means the same thing as stock and all that. So they mostly interchange it, depend on the country and all that. So there are little difference when it comes to stock and shares, but they mean or they talk about the same thing. So a share is measured in units, while a stock is measured in full proportion. Now let's take Amazon as a case study. I can say I just need 100 units of Amazon shares, or I just bought a stock in Amazon. So a share is measured in units. Why? Because it is a portion of a stock. So you can either say shares or stock. But publicly trading companies, they deal mostly on stocks. So either you say a stockholder or a shareholder, they are the same thing. Why? Because they are publicly traded companies, so talk about stock. Or if it's a private traded company, you can talk about shares. I own a certain amount of shares in this company. I own a certain amount of shares in this company. So a stock mostly entails ownership of a part of a company. So you get involved in the decisions and the decision of what the company does and the activities of the company. So that is a stock. So in this video, we'll be talking about how do you invest as a beginner. How do you invest as a beginner? So you need to understand first of all what you are going into. Investing in stocks and buying of shares, it is not a rich quick scheme. Rather, it is an investment for a long period of time. So you don't invest in stock or you buy shares and you're expecting a reward anytime soon. No. So which is why when investing in stock, you are investing a percentage or a portion of your income that is reserved for investment. So it has nothing to do with your savings. It has nothing to do with your emergency funds. Because if you watched my previous video, we talked about our day-to-day lifestyle structure of our finance. We talk about saving, expenses, and investment. So the portion of that you've saved for your investment is what should be used when investing in stock. Do not use the money you need in a week time or in 2 weeks time to invest in stock, hoping to get returns. You could be disappointed. So if you are going, or if this is your first time of buying shares or buying stock or going into it, or you're thinking of going into it, do not come with a mindset that it is something that you do that you get a reward instantly. It is something that you get a reward over time. So how do you invest in stock? There are certain criteria, there are certain things you need to put into consideration. Number one, you decide your investment approach. You decide your investment approach. Now you can either decide to trade individual stock or you are trading in index funds. You are trading in index fund. Now, trading in individual stock more or less talks about your trading in or you are buying an individual stock from an individual company. Let's take for instance, I want to buy Google stock. And you just okay, I have $500 or 500 euro. I want to buy Google stock. Or I want to buy Amazon stock. You buy an Amazon stock and you become a shareholder. Or you say, okay, let me buy Apple stock. You are buying Apple stock. So these are individual trading. So also trading in index funds talks about multiple stocks put together, evaluated in an index. Whereby purchasing an index stock, you are purchasing a complete entity of what is inside that package. So that way, when you are When one stock is failing and another one is progressing, you don't lose all your capital. So let me break this down a little bit. Now, an index fund will be a combination of different individual stocks. Let's take, for instance, we have Amazon, we have Google, we have Facebook, we have Apple. So these are individual stocks, but combining them together, they form an index fund. They form an index fund. So you buying an index fund, automatically you become a stockholder in these major corporations that I just mentioned. So just a single purchase, you become a shareholder or a stockholder in Amazon, in Facebook, in Google, in Apple, in just one stock or in just one purchase. So that is what an index fund represents. That way, if Facebook is not doing well, Amazon is doing well, Google is doing well, you're on the safer side. But when you purchase just a single entity or a single individual stock like Apple stock, and you put all your finance there, the moment Apple runs at loss, you definitely run at loss. You lose your capital. But in an index fund, the percentage of all the various companies losing its funds is not likely to be so. You either have one losing, one gaining, or the other losing, the other gaining. Such way creating more or less like a balance. So most financial advisors always advise individuals or newly investors to go for the index fund, whereby you can either trade in international funds or local funds, whereby it is a combination. Just like the popular one we have in America, we have the S&P 500. This consists of 500 different companies put together, major companies put together to form a single entity. Thereby, by purchasing the S&P 500 with just a single purchase, you are owning a share or a portion of all the 500 large companies in America. We also have the Nasdaq, we have the Dow Jones and all that. So many index funds that we have. So you need to decide on the approach. Before you do that, you need to get a financial advice. You need a financial advisor to advise you on what and what you need to do in order for you to start investing in stocks. So the index funds is your best bet. Index fund is your best bet, whereby you own a percentage of all the major corporations in the world. You could actually even opt in and get an American index fund, which consists of all the major companies or all the companies in America, or Euro funds, or Eurozone funds. There's also one in Europe that they call the Eurozone. Consists of major corporations in Europe. So we have series of funds, but your financial advisor will be the one to advise you on what and what you need to do to start. So one, you decide your investment approach if you are going for a single entity or you are going for a larger entity. Now, do not be mistaken. You can actually get success by purchasing just a single stock or from a single business. But the risk is also high because there's a chance that that company might likely to fail or will progress. And if that company fails, you lose all your capital. But if the company succeeds, you make it financially. But there's a problem with that. Having the foresight to know a company or a newly startup or a trading company that you are starting or you want to buy a stock in that will make it alone in the future sometimes takes greater insight to get that. That is why most people prefer to go for index funds, combination of different corporations to form a single entity. So number two step to invest in stocks for beginners, decide your budget. Decide your budget. I've always emphasized on creating a budget. Now, when it comes to investment, you also decide your budget. Okay, what portion of my budget do I have to put in investment in stock, in shares? And mind you, like I said earlier on, do not use money from your savings, hoping to get return in a short time. So, decide the budget in which, or the allocation which you want to put into your investment. Now, most times you could get €1,000 and you decide to you want to buy a share or you want to buy shares in a particular company. When you speak to your financial advisor might tell you it is not good to just buy or spend that amount to buy a single entity or from a single company. Why not go for index? That way, the money will be spread across all boards. You will not be thinking of if it progress or not. So what they will do, they will also tell you to, okay, this is how it works. They just start a plan for you, just start a budget on how you can start the process. Because you are the one that will define the budget you want. So whenever you go to a financial advisor, the first thing they will ask you, what is your budget? What is your budget? How much are you willing to risk in investment that will not put a dent in your day-to-day activities as regards money? So you will not be the one to check yourself because why you've already created a budget and you know the certain percentage that is going for your investment. Then you set up a budget. And then you can be put on a monthly auto investment. So like I said in my previous video, the 10 ways to save and build wealth. I mentioned automate savings and investment. So your financial advisor will also enlighten you on that as well, whereby you automate your investment. So at a certain time, at a certain period, certain amount of money is going directly to your investment. So having decided your budget, you should also know your risk tolerance. Investing in stocks is sometimes very risky. You stand a chance of losing your capital, your finance, you stand a chance of losing your money, you know. But in the long run, sometimes it's beneficial, you know. So you must know your risk tolerance. Experienced investors, they have this aggressive, risk tolerance, whereby they are willing to risk it to get that gain. So whereas we also have the moderate risk tolerance, whereby it is moderate, not too high, not too low, but it is moderate. We also have the conservative risk tolerance, whereby you don't want to lose any of your capital at all, but the reward will be very, very little. So the moderate, you are able or you are likely to lose a little bit of your capital, but it's okay. But the aggressive risk tolerance, there's a chance of you losing it all. So this part is for the experienced investors, the brokers, and all that they use because why they are experienced in that field. So you must know your risk tolerance, and it also depends on age. Sometimes your financial advisor will also ask you your age. How old are you? You tell them your age, and then they will be the one in their own discretion to also want to guide you that will be of best interest for you. Because in your early 30s, aggressive and moderate is on the safer side. But if you are from 45 and above, you have to go for a conservative risk tolerance whereby because you are close to retirement, so you don't need anything that will take whatever you have left of your finance or of your capital. You know. So for youngsters, the risk tolerance is always moderate. So you must know your risk tolerance, the risk you are willing to take for this investment operation. So another step for you to know to invest in stocks, you need to set up an investment account and fund it. Setting up an investment account, you need to open a brokerage account. We have thousands of brokerage accounts that you can start using to invest. Most of the time you can invest alone or you get assistance to invest. So which is why it is very much important that first of all you need to go to your bank. If you have little or no idea about what it entails for investment, you go to your bank, you speak with your investment advisor, and then they will advise you on what you need to do. All these things I have stated out, they will also ask you need to do your investment approach, your budget, your risk tolerance. Your investment advisor will ask you the same thing before they create the accounts for you because they will want to know what and what you need to do, how well are you able, or how long you intend to hold this investment for. I could remember when I went for my, they brought up a chart, they gave me all the insight I need to know about what it entails, the duration, the capital gains, the losses that might arise at a point in time, because it is not a get rich quick scheme. It is something that over time produces results. Because sometimes the market might go bad, you might lose capital, but definitely it will go back up. So there are chances that in the long run you get the rewards of your investments. So you need to set up a brokerage account, go to your bank, speak to your investment officer or your investment advisor, and then they will ask you these questions just stated out, not quite long. Then they'll open a brokerage account for you, and then you fund it. And they will also ask you, do you need something that you will be monitoring yourself, or you also want them to get involved with you? Normally they do charge and all this stuff. But if you need something that you want to be controlling by yourself, won't you and you alone have full access? But if it's something that you want them to also get access to, you also get access to it from their own system whereby they guide you on what and what to do. And it might interest you to know that all banks in Italy have their own investment portfolio that they work with. So all banks, the moment you go to your bank and you tell them you want to invest, they all have their broker that will guide you in what you need to do and how to invest in the eurozone, in the euro market, in order for you to build your portfolio. So another step to invest for beginners, pick your stock and set your financial goal. Like I said, our first step is to decide your investment approach. Now, number five, you need to pick your stock, and set your financial goal. That is something also your investment broker will also ask you. Do you have anything in mind? Have you done any research, or do you want us to, get you give you insights on what and what you need to do? You know? So when they pick a stock for you after opening your brokerage account, they pick a stock for you, and then they invest in it either in index or a single fund, and then they invest in it for you. So it is very important that you understand the facts of investing for beginners. Then the last step, you need to keep on investing. You do it every month. That is why I said you have to automate your investments. So you keep on investing every month. So in the long run, then you will understand how it goes. Because while your investment broker or advisor will give you the breakdown of what you need to know when it comes to investing in stock. So the younger you are, the more risk you can take. That's the biggest leverage you have. The more risk you can take in order for you to get more results in your investment. So our biggest leverage now is time. Because why? We are young. So the time to start is now. Investing can be very, very complicated. It's very, very complicated, but all investors started small and with time gain the knowledge of how the market works and how the stock exchange works. So you have to start small and start investing. If you live in Europe, rush down to your bank, speak to them. But before you go, create a budget. Create your scale of preference. And then you make a budget of how much you are willing to invest for the future in stock every month. So I hope this video finds us in good faith. If you like this video, share, subscribe for more. Until we meet again, it's your boy, Young Diamond. Peace.